Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch, and in today's ROCast, we're speaking with Todd Warren, a partner and head of research for Tribeca Investment Partners. Tribeca is a global investment manager with multiple strategies across equities, credit, carbon, and global natural resources. Join us as Todd unpacks strategies in which he specializes in. These include the Listed Resources Fund, TGF, the Unlisted Main Fund, the Tribeca Global Natural Resources Strategy, the 2050 Strategy, the Kimberley Syndicate, which specializes in diamonds, and the Nuclear Energy Opportunity Strategy, which is currently having its time in the sun, averaging 40.96% over 5 years, 34.9% over 3 years, 35% over the past year, and averaging 31.43% for the past 6 months. For me, I really enjoyed hearing Todd's thoughts on what's currently driving global resources, where he sees global resources going, and how they are investing in specifically what companies in or commodities in carbon credits, natural gas, coal, iron ore, steel, copper, uranium, and diamonds. Before we get into the conversation, please remember this podcast is made for entertainment purposes only and not to be construed as any form of advice. I encourage you to listen to the disclaimer at the end of this ROCast and to keep your feedback coming. You can reach me at mgatti@ywm.com.au. So, with that being said, I hope you enjoy this conversation as much as I did, so sit back, relax, and enjoy it. Todd Warren, welcome to the Rate of Change with York Wealth Management.
Thank you for having me, Murdoch. Pleasure to be here.
We'll have to thank Adam Curtis for that fantastic event at Seed Partners for us connecting. That was quite enjoyable.
Yeah,
good turnout.
It was a great turnout, excellent turnout. No, the Seed guys do a great job. Very supportive of trying to get our story out there. And at the end of the day, resources is not everyone's favorite flavor at all times, but we're trying to convince people otherwise.
Absolutely. So for people that aren't familiar with yourself, Todd, who's Todd Warren and how did you get into financial markets?
Yeah, so I've been, for my sins, in financial markets for, what are we now, closing in on 30 years. I joined what was then First State Fund Managers, part of the State Bank New South Wales back in 1996. And that was in the throes of being consumed by Colonial at the time and becoming Colonial First State, and spent best part of 23 years there doing resources for most of that, and then joined Tribeca about 4 years ago now to again work on the resources business here.
How big is Tribeca? If anyone jumps onto the website, you can kind of get confused that you might be looking at a gigantic investment bank. But there's, obviously, and then there's also resources as well. So what's the business model and, who is Tribeca?
Yeah, Tribeca's been around for about 25 years now. Originally started out managing with a small cap Aussie equities focus. But the original DNA was really to offer niche or specialist products that are difficult for others to replicate. Now, 25 years ago, Aussie small caps was that. Things have obviously moved on a little bit, and that's, not an uncommon offering these days out there. But the DNA still remains true, and, we continue to focus on those niche products. So, we launched a global resources offering where I sit, what are we now, 9 years ago, 2015. And also offer some other products like there's an Aussie Equities 130/30 product run by Junbei Liu, who you may have seen. She's quite high profile. We offer Asian credit, Asian infrastructure, and then some other more nichier parts of the resources world. We offer a Nuclear Energy Opportunities Fund, which is having a nice little time in the sun now with the resurgence in interest in nuclear power. We have a decarbonisation strategy, which is a 2050 strategy, and then we offer a Kimberley Diamonds Trust, which is only invests in uber rare Kimberley diamonds.
I think that's a good intro summary. So why don't we crack into on the resources side. So how many funds in the resources space would you oversee?
Yeah, so, well, as I say, we launched the Global Natural Resources, I guess the mothership, about 9 years ago, and that's a go anywhere, anywhere in the resources spectrum, really. So hard commodities, oil and gas, traditional energy, new energy, or indeed soft commodities and into the ag space. And it's a long short product and a global mandate. We also have, as I touched on, that nuclear energy opportunities vehicle, been running now for what are we now almost 6 years. And that focuses on nuclear energy and uranium miners, developers, explorers, and of course the new technologies associated with it. We launched our 2050 strategy in 2021, and that is very much focused on decarbonisation related investments. So there's a crossover with our resources strategy, being the ability to invest in the enabling commodities, but then also spreading into other aspects of the decarbonisation thematic. And then, as I say, the Kimberley Diamonds Trust, which is about 18 months old now, and that's just very focused on, as I say, uber rare diamonds, Argyle diamonds, as it happens, and we call it Kimberley Diamonds Trust. We have a carbon credit capability as well, and carbon credits, of course, has had some good times and bad.
It's kind of like my brain's just going, which one do we pick apart first? But look, let's start with something that, everyone's going to want to know what's happening with uranium, copper, gas, all the fun stuff, right? But I think we should definitely touch on carbon before we forget about that, because that there is incredibly interesting, considering the amount of input and the government had, essentially forcing and creating an industry which benefited some and then destroyed other businesses. And then eventually, after they put it in, about a period after that, they proceeded to change it all over again. So everyone that had invested money, I have a couple of friends that did this, everyone that had invested money, they moved the goalposts.
Yep.
And it was incredibly difficult for them to pivot for some of these people. Luckily, they were, came out okay. Do you mind giving a bit of color around what's happening in that space? And what happened?
Yeah. How long have we got? It's a complex space. Point out. So maybe just to give a little bit of background and some sort of carbon 101 first. So every carbon credit is equivalent to 1 tonne of carbon. And then if you look at the carbon trading markets, there are two types of carbon credit. There's either a compliance market or a regulated market. So the Australian carbon credit units, the ones you're referring to, are the Australian government regulated carbon credits. And there are similar types of regimes in countries all around the world. The most mature, liquid, deepest, broadest market is the European market. Been around for a long, long time. And they are the European allowances, the EUAs. And all of them, regardless of what price you see quoted, are all, as I say, equivalent to a tonne of carbon. But importantly, you can't funge across markets. So if you're a European emitter, for example, and you've got a carbon price of 60 euros a tonne, you can't come into the Australian market and buy an Australian carbon credit unit, an ACCU, for 35 Aussie dollars a tonne and take it back to Europe, because the rules are different and the regimes operate quite differently. There's also, then, to add some complexity here, is there is a voluntary carbon market. And that is a whole other kettle of fish again, where you've got individual developers and individual projects. And it's a bit akin to an equity market where you're picking stocks. But it is an OTC market, over-the-counter market. Pricing's very opaque, and liquidity can be very limited. So you need to wear your big boy pants when you're in that market. With regards to your point about what happened in the Australian market, yeah, look, we can peel back the layers of the onion there. You'll recall that this was a program or a regime set up by the Abbott government originally. And that's probably a key point to focus on initially, given the extreme scepticism under which that government viewed carbon emissions. And then I guess, again, to provide a bit of colour to why or how, what drove the shift in the goalposts, as you pointed out. We were approaching a federal election at that time, and there was some criticisms being levelled at the regime by some architects of the regime, but then also there was this store of credits that the government had built up, and they, in one fell swoop, push those into the market. And that is the problem of trying to operate in a market where you are at the whim of government regulation. And it's not just carbon, for that matter. There's all sorts of examples of government regulation, distorting markets. But yeah, as you rightly point out, that through the Australian carbon market sideways, we went from sort of mid $50 a tonne to $30 almost overnight. And then, of course, we were approaching the federal election, which, of course, was won by the Albanese government, and they swiftly announced a review, the Chubb review, of the Australian carbon market, and that then created more uncertainty and concerns or erosion of confidence, really, of the Australian carbon market, because there was the expectation that they would put the cleaners through the market and make some wholesale changes. Roll forward, and actually what they didn't do was make wholesale changes. What they actually found was that the market was actually reasonably well structured, required some tweaking around the edges, and there will always be those sorts of tweaks in any nascent market. But what we've got today is, the Chubb review established or recommended at least what they call the safeguard mechanism, which has been rolled out now. And that's actually a very similar market to the European market. It's what's called a cap and trade market, where you set a ceiling of emissions for the biggest emitters in the economy, and then they are required to reduce their emissions every single year. In the Australian case, by 4.9% every single year. If you are able to do that at a faster rate, you generate a credit that you can then on-sell to someone who's not able to reduce their emissions fast enough. And that's what creates that trading opportunity. Not a straightforward market, and there will continue to be people who criticise the market. But by the same token, we need to put a price on carbon. And this comes back to the whole, I guess, theoretical argument around carbon credits. At the end of the day, human behaviour is changed by a hip pocket imperative. It doesn't matter how altruistic we want to be. At the end of the day, 99.9999999% of us will only shift our behaviour if there's a hip pocket imperative. There's an economic imperative to do so. So that's where we need to have a price on carbon. And ultimately, our view is that price of carbon will or needs to continue to climb to drive a shift in behaviours.
You're not wrong. I think we need an entire podcast conversation purely just on this topic.
Indeed.
To paint the picture a bit, because no one can see the chart, you mentioned a couple of numbers there. What's the price done, and what's the price currently trading now for carbon credits in Australia?
Yeah, so
that's either Europe.
Yeah, the generic Australian carbon credit trades at around about 35, 36 Aussie dollars a tonne. So I mentioned some numbers earlier. When the Abbott government was created it, the price ran up to, peaked out in the 50s. And then, of course, we went into the last election and the price had collapsed to under $30. So it dipped well into the 20s. Post Chubb review, as I say, we've now managed to climb back well into the 30s. And you can paint a pretty good argument as to why it should continue to climb. There is more confidence in that market today. And there is a growing realisation that there's a structure in place now that is more sustainable and should drive a more stable and increasing market.
Obviously, you can paint the picture on why this is a good thing. But the question I've always had in the back of my mind is, how can you play a game in a sandpit, when kids on the other side of the fence just go, why the hell are you even playing that game? And then, other people are like shaking your finger going, no, you must play our rules. It's just like, hold on a second, mate. In life, it's not black and white. Life's grey. So how do you deal with big ugly gorillas like China or, Southeast Asia that go, that's very nice that, you feel this way, but, we're just going to keep doing what we want. And other people may say that, look what's happening in Europe. The farmers, the European Union, WHO, pushing down these draconian, as you said, government regulations on how things should be done, and it gets to potentially to a point where businesses can't operate. And the one that always, flashes back in my mind since I grew up in Sydney is, King's Cross. King's
Yep.
Cross used to be the place where everyone used to go out and have a bit of fun. When a couple of guys and girls sat in a back room and goes, hold on a second, there's a huge amount of land sitting right there which we can't access. How can we remove them without physically doing force? Well, hold on a second. If we just put a cap on when these people can party and sell alcohol, then these businesses are going to go bankrupt, and we'll be able to come in and pick it up for a song. So I'm just curious in your opinion with carbon credits, because I do see the benefit for the world, and I do understand that. But if other countries aren't willing to play the rules that a larger globalist thought process is, then what's the point? Yeah, like using the farming analogy, is this a business ploy by the top elite to essentially reduce the asset prices to force businesses out because they can't afford it and then come in and picking up assets? Or is this generally done to essentially improve the world? Hopefully I've phrased the question correctly, but I've been
No,
thinking about this for years.
yeah, it's very complex. You're absolutely right, and the the easy the easy answer here is to do nothing, and sit back and say, well, we are Australia and we are, a pimple on the arse of the world, excuse the French, and we don't matter. What we do actually doesn't matter, because, as you say, when you've got the world's biggest economies behaving very differently, then ultimately what we do doesn't matter. What people, I think, fail to recognise is that there's a couple of things going on here. Number one, actually, China does have a carbon market. Happens to be the biggest by tonnage in the world.
I did not know that. How interesting.
So they do have a carbon market, but also I would point out, and this is another factor here, which is often pointed to, is that the Chinese continue to build out their thermal coal-fired power. They do. That's a fact. But what they're also doing is they are investing more than anyone else in renewable energy and nuclear power and hydropower. The fact is they've got one of the world's biggest population bases, so they need every solution. Now, the other aspect here, of course, is who are we? And this comes back to your point about, or question at least, regarding, is this just a ploy by the elites to suppress those beneath them? Very philosophical question for this hour on a Friday morning. But look, the reality is that that is a very relevant question, and it's why the entire ESG, and I broaden this out to an ESG conversation. It's why ESG perspectives and investment has had to progress from the simple ESG 1.0 of just turn off all the thermal, fossil fuel consuming power generators. That's not realistic. Who are we to say that we in the West have gone through industrialization and developed our economies, and you in the developing nations, well, good luck. You're not allowed to burn fossil fuels anymore. Well, that's not realistic. But what we can do is, and this is where the COP conferences, the climate conferences that take place every single year. This year was in the Middle East, COP28. A couple of years ago was the very high-profile COP26, which occurred in Glasgow. These conferences are a bringing together of all the world's leaders, both at a political level and at a corporate level, to try and navigate this very issue. And it requires very significant investment by developed countries in developing countries to essentially address this very issue. So that may be, the investment in renewable power or nuclear power, whatever it might be, by the West into developing countries. Who are we to say to Bangladesh, which sources 100% of its power from thermal coal, no, sorry, you've got to turn it all off. And, if that was, this is observing the ESG 1.0 perspective, that they would be very quickly be plunged into horrendous economic circumstance. People would die, millions of people would die, either by starvation or some other consequence. So, look, there's a much bigger picture, and as you say, this is probably a whole other podcast entirely.
No, I was actually thinking about it. Obviously, anyone can go have a look at the website, look at the numbers, see the results. We can just get into what's happening with prices and all the fun stuff. But after having this conversation, I think we keep going on this path because the question that I think is the most interesting is what drives behaviors, right? So if people can get anything from this conversation today, I'd love to hear your thoughts on, why things like ESG, have been created. It's a great question. There's always the question: is this good for the people, or is this money driven, or at the end of the day, is this purely power driven? Right. And if people can, and the thing with resources are cyclical, right? And they're cyclical on the basis of basically demand and supply, the basis of all fundamental markets.
Yep.
So the question is, what is driving the demand and supply is potentially the fiscal policy created by these countries, as you mentioned, like Bangladesh. So the question then becomes, okay, why has ESG been created? Here's the question. Do you think ESG was purely created as the West's means of trying to wean themselves off Russian gas and, off that reliability of the Saudis? The four largest gas deposits in oil, what is it? Saudi Arabia, Russia, Gas's Marcellus Basin, and the States, not as much. And then we've just found some in the Beetaloo Basin, right? So using that as the geography,
yep.
What else is the West's options if we go to war?
Wow.
You know what I mean? Like, it's just, I find this quite interesting because if you can understand the landscape, the global players and how this all works, then potentially investors may have an understanding of why these cycles occur and where to allocate and why these markets like carbon credits potentially exist, not the fact that they currently exist and how to play them. I'd love to hear your thoughts. I don't know where we start in this, but
we're disappearing down a rabbit hole. It's an interesting rabbit hole.
Need a couple of scotches and cigars for this one. Sorry, it was 9 a.m. Should have done it in the afternoon.
Indeed. Look, I mean, ESG has been around a long time, right? It's just that it's become a bit of a catchphrase in more recent years. And as a resources investor, these factors are factors we have had to consider from day one. It's just there wasn't an acronym that described it. And somewhat frustratingly for us as resources investors is that there was this E, S, and G acronym, but really it was capital E, small s, small g, and particularly being driven out of Europe. Now, the ESG drive really manifested itself in its simplest form in, sell or avoid, the investment in fossil fuels. Now, obviously, in more recent times, there's been this, realization that being reliant on certain geopolitical players for their natural resources is probably not wise. But that's sort of been, it's become a separate issue, not because of the ESG factors. But I'll come back to that. But if you'll humor me for a moment, we've been openly critical of the divestment push of many players in the market to say, well, you need to, being activist with super funds or companies to divest their thermal coal assets, for example. Selling a thermal coal mine doesn't make it go away. Indeed, all it does is drive it into the hands of private equity, state-owned entity, essentially players who have zero concern for or cares for the environmental consequence of operating that asset. So pushing BHP or Rio Tinto to sell their thermal coal mines is actually a negative outcome for the environment. what should be driven is to get inside the companies and say to them, right, you're going to operate this thermal coal mine and you're going to do it to the best of your ability. And when its life has expired, you will close it down. And we will be watching over you like a hawk to ensure that your remediation liabilities are met in full and that the communities are not suffering as a consequence. But just handing that mine, the keys to that mine, to a private equity outfit or to a state-owned entity who will continue to operate it, indeed probably for longer than a BHP or a Rio or whoever would operate it, is not a good outcome for anybody. So, to our view, that's where, the ESG 1.0, which frankly was, as I say, a negative outcome, is progressing to a 2 or 3.0, where, for example, a portfolio company of ours, Glencore cops a lot of criticism, for, look, ills of their past, no doubt, but also because they continue to be a thermal coal operator. They're actually one of the best coal operators in the world, and have made actually more aggressive commitments around their scope 1, 2, and 3 emissions than BHP or Rio Tinto. That, to me, is a better outcome.
Yeah, it still blows my mind how policy can essentially dictate markets. And the funniest thing, like, I'd love to hear your thoughts on coal. As you said, China hasn't stopped, and then everyone's like, we're decreasing the mines in Australia. But what is the volume of coal being exported from Newcastle through to China? Hasn't that increased?
Yeah. Well. So there's a whole other argument. This is an argument that Whitehaven actually make: is aren't we better off exporting the highest quality thermal coal that comes out of Newcastle, 6,000 kilocal thermal coal, than burning, high ash, low energy content Indonesian thermal coal or Chinese thermal coal? Look, the reality is it will continue to be burnt. What we need to do is actually address the consumption behaviours. And this also goes for, talking about oil and gas. The governments around the world, to your point about policy, beat up on oil and gas producers, but at the same time, they then subsidise the fuel costs for the consumer. It's like, well, hang on. If you want to change behaviours, it comes back to the point I made earlier. You've got to change the fiscal impost of doing so. Make it more expensive to burn fuel. People will stop burning it if it's too expensive to do so. So, like putting a tax on, or increasing the impost on the oil and gas producer, that's not the way forward in my view. I mean, in Australia, and again, let's just be down the rabbit hole for a moment on gas. We've seen gas prices start to climb, and the so-called East Coast gas crisis, which is, by the way, the slowest moving train wreck you've ever experienced. We've seen this. This has been coming for years and years and years. And gas prices start to spike. And what does the government do? Instead of saying, right, we've got to let it spike because that will actually slow consumption, we're going to cap it at $12. What does $12 do? It actually constrains supply and encourages demand. It's quite the opposite of what we're trying to achieve here. So all it does is force actually a more acute problem from a power perspective. I mean, here in Sydney, we've had power rationing a couple of weeks ago in this office building. I sit in the CBD of Sydney. Now, I don't recall that occurring too many times in the past. And this was not a stinking hot day. So that, to me, is actually pretty worrying about the pathway forward. And yet you've got, you've started me off now. You've got a situation.
Yeah, this is half the fun of it. Like, I'm actually letting you talk. I just want to jump in and go, what about the Australian government's done to international money, right?
Yeah.
And then we can go into since we're on gas, I would love to hear all about your thoughts on the Beetaloo Basin, because I believe you got a holding in Tamboran, right?
Yes, we do.
That there, in my opinion, is potentially one of the best unsung assets that will solve all our problems. But I've been watching that as if you're watching your favorite TV show like The Witcher or something like that go into the hands of Disney and just get completely ruined because someone that's never read the books or watched the movies or whatever who's writing this stuff just doesn't care because they want to put their creative spin on it, and it's a goddamn train wreck, and you're just hoping that someone's going to jump in and save this, for the good of the country. I don't know how else to explain it.
Yeah, the dreams of the Beetaloo, again, are not new. I can cast my mind back to meeting Falcon Oil and Gas 10, 12 years ago, when they were planning to put their first wells into the Beetaloo Basin. Of course, there are a few challenges, not least being the location. It is extremely remote and will require not inconsiderable investment in infrastructure to bring any gas molecules discovered or produced to the market. What we've had more recently, and as you say, with regards to Tamboran and their recent news, you've actually got a well result that is for the.
What was the result?
So they've drilled a well which has delivered on a 30-day sustainable flow rate of the equivalent of, it was a 500-metre horizontal well. And in the global scale, that's actually a very short horizontal well. And sorry, I'll take a step back. Traditional wells are drilled vertically. More recently, the unconventional way of drilling wells and what's really been rolled out and developed significantly in the US and Canada is horizontal drilling. And that way you can obviously expose a much more significant component of rock to extract more of oil or gas. These guys have drilled a 500-metre horizontal section and fractured the rock, and they've delivered 3.2 million cubic feet of gas a day on a sustained flow rate over 30 days. For those of you who that means absolute gobbledygook, this is sort of the first time we've got what could be an economic flow rate from these wells. These are expensive wells, but if you were to drill and complete this well using, cutting edge, the best rigs, the best completion techniques coming out of the US, the ultimate aim is to drill something like a 3,000 metre horizontal section, frack it considerably, and then deliver something in the vicinity of 20 million cubic feet of gas a day. Now, that is more in the realms of some of the most prolific gas basins in the US. And that's really what you need to prove up the economics of this basin and indeed justify the build out of the infrastructure to bring those gas molecules to market. What Tamboran have got is quite significant investment from some large US players, and that's really what's been the game changer, is applying the best rigs and the best techniques to enable this to occur.
Yeah, I should probably disclose that one of the assets, when all the assets with EP136, I helped finance getting all that up and running. So I've been financially embedded in this thing for a while, watching it all play out. Again, it makes a lot of sense, but I think the thing Australians don't understand about gas and the Americans get completely is how much capital is required to the life of this. Like, people just expect, I gave you $50 million or $60 million raise, or here's 80. You're good to go, right? It's like, no. This thing here is potentially a $500 million US project that will actually benefit from a bond. But the equity markets are what the equity markets are, and games are being played, and people want equity and assets, and then you find yourself in a dilution trap. So which is challenging, but I definitely like what the guys are doing there. Look, from your thoughts, how much money do you reckon they need to get this thing up and running? Because, like, as you said, it's a glacial pace for the East Coast gas situation, but we're going to need it, and I can't see anywhere else that has that amount of gas to consistently supply Australia?
Yeah. Look,
I'm open to your thoughts. So obviously I'm a bit biased, but I'm just curious since you're also invested in it. Just
yeah.
curious.
Well, I mean, right now they got a little over $50 million in the bank. This, what they call their pilot project, is a 6-well program plus a 35-kilometre spur pipeline to connect it with what's called the Amadeus pipeline, which flows up to Darwin. Good question as to what they'll need. These are expensive wells, and you need big rigs with big pressure pumping spreads to complete the wells. Realistically, if you drill them all on a pad, which is what they're planning to do, 6 wells all from the same pad, you can probably get away with spending something in the vicinity of $150 million. That's gross. Now, bearing in mind that Tamboran are a snick under 40% of this asset. So they are the operator and own about 40%. So, in a best case scenario, they have the existing cash in the till and they will be able to raise some debt to do so. As Joel Riddle, the CEO, said the other day, the exploration phase is over and we're now into development. I genuinely hope so, because it's been a pretty long road to this point. And look, let's be honest, the company have not done themselves a lot of favours by largely over-promising and under-delivering and having some operational issues. I think the reality is they will come back to market for more equity to fund the pilot. At what point? I mean, not immediately. As I say, they've got $50 million in the bank, so they can fund the next couple of wells. But the likelihood is there will be some more equity required, but they'll be able to get some debt.
Yeah, the good old-fashioned equity raise A, B, C, D, E, F, G, and no one knows when it's going to end. But the other thing which I kind of find very interesting, we're discussing infrastructure, and absolutely let's pivot into other commodities. But the requirement which people don't see of, like say, a gold mine. If you stick in a gold mine in Kalgoorlie and you find a tenement, well, there's already infrastructure around 20 kilometres down the road. You literally just roll it in, pay the bill, and off you go. The Northern Territory is like virgin land. There's nothing there. I think the government gave them Tamboran a $1.5 billion grant to essentially build a terminal right next to unpacks.
Yeah, that's the plan. So
is that going to even come through? Like, is this a thing with? I'm speaking a lot of the international money, right? As in, there's promises, and then so people are happy to back these plays, but then the governments or the greenies, again with politics, as we were discussing before, just moves the goalposts, and then people are standing here in Australia just going, can we just have a view for 10 years so we can make a plan?
Well,
which is hurting all Australians.
You're touching on, obviously, a massive issue here, and not least of which was the challenges that Santos faced most recently with their Barossa project too. And we need, to your point, desperately, some clarity on the government's stance here, and indeed the regulations, the rule book that these companies need to follow. Because the problem that has clearly surfaced most recently with Santos's Barossa project was that they observed all the rules as they were written in the rule book, and then the court came along and said, rule book doesn't apply. We need a new rule book. So there is, it becomes the laughing stock, really. Australia has become the laughing stock globally in terms of shifting goalposts, and no company will invest in Australia with that sort of uncertainty overhanging them. So, I think what ultimately has come to pass with regards to the various appeals that were lodged by the Environmental Defender's Office with regards to the Barossa development, Santos Barossa development, have been thrown out, and it does pave a pathway forward for development, whether it's Santos and this is so the bit that's I think many have missed here is that were Santos to be precluded from laying the pipeline for that project, the reality is that what it does is affect every offshore activity, not just pipelines. And what do I mean by that? I mean offshore wind farms. I mean power cables for said offshore wind farms. Any offshore activity would be similarly impacted. And I don't think the agitators on this were really taking that into account.
But how do you plan to build any mine, any commodity, like to essentially?
Yep, you
And
need
how do these policies being created when everyone knows the problem that we have, essentially a supply
yep,
problem across the board
yep,
in many different areas, copper, uranium, natural gas? Does anyone think these policies are actually helping, or again, are these? I just want look. We haven't had a war for how many years now? It's nearly a century. And I'm just wondering, if it's like the Matrix. There's actually a war going on, but we're very happily in our little baths watching TV, and it's
yeah.
going on quietly in the background. It's an economic war. I'm just wondering what is happening, and does it benefit some countries for these, this infighting or internal civil war and policies to occur, and it doesn't expand, and then assets get bought cheaply? I'm just
Well, yeah,
wondering what is really happening.
you're moving
It
into. I
can't
mean,
be stupidity driving this thing to an
the,
extent, surely.
the supply issues we face, as you say, with regards to pretty much name the commodity, right?
Yeah.
Are significant. Not least because of the reticence of the companies to invest, but it has never been more difficult to permit a new mine anywhere in the world. Now, that comes down to some factors which are very appropriate. The science and the knowledge of the environmental impacts is higher, so we should properly assess all of those said impacts and ensure that they are addressed appropriately. But by the same token, when you get mired in issues like Santos have, when the rule book gets thrown out the window, then you cannot expect, regardless, frankly, of the commodity price, companies to invest in new supply if the landscape is so uncertain. So, when you've got a situation like that, it creates significant supply challenges, and this is part of our entire argument around, what we feel is a real golden age, developing for many commodities, because traditionally, as you say, resources was, and will be, a supply and demand driven economics 101 sort of environment or industry. But the problem we've got today is that the supply response to high commodity prices is no longer straightforward. And to put it in perspective, the traditional rule of thumb for developing a new mine was that it would take you between 7 and 10 years from first successful drill hole to first production. That was your rule of thumb. Obviously, there's exceptions to the rule. That 7 to 10 years today is more like 15 to 20. So you find something today, you will not see the fruits of your labour for 15 to 20 years. Now, if you are a board member or a management team of any company, there's a real likelihood that you're not going to be in the job in 15 to 20 years. Indeed, we criticise boards for being in place for that long. So who's going to commit to that sort of project when you're not going to see the fruits of your labour? This is the huge fundamental issue we face with regards to new supply of many of these commodities.
But how do you invest that way? Because I'm looking at your portfolios. You've got a small caps fund, which I'm assuming you'd probably take new issues, new things coming up, great asset, and then you've got the larger cap, so you break it up, right? But how the hell do you look at potentially supporting, someone, goes find something on the land, needs money to get out of the ground, and then you just go, sorry, mate, it's just not commercial. How do you invest in this climate?
With challenge. Look, there's a typical curve that resources investment follows, and share price charts follow. There's the initial, boring, what appears a flat line, on the chart of, very small company trying to raise money from family and friends to go out and drill their first hole. They then get a sniff, and they might come around and raise a bit more money to drill the next holes, and you start to get some excitement, and you get that excitement curve run up as that arm waving period goes on, and there's the hope and dream that you've found something career making. And then you go through the long, drawn out period of delineation where your drilling isn't actually adding to the size of it; it's just proving out what you've got. Doing your studies, you're proving out the size of your resource, doing a feasibility study to see whether it's actually economic to dig it out of the ground, going through the funding process, getting the funding to build it, and then going through the build. And ultimately, it's probably going to cost you more and take you longer. And then finally, after you've gone through this long, boring, horrendous slide down, you go into production and you start generating cash, and then you're up and away. And that's a very typical life cycle of a resources company. It's not easy.
When you sound it just sounds like there's an expression running around which I don't like, which is you will own nothing and you will be happy. Meaning we'll own everything and then you work for us. So what I'm kind of hearing here is, and you're seeing it quite a lot, that people, and look, it's great for companies like Santos and the big entities that have the capital, have the means to, and have the connections to get things done. It just also means that unless you have those connections, those resources, great projects, which people need to actually go about their daily lives, might not be there, and hence the supply suffers. But I suppose it is a game. It is 3 or 4D, chess at the largest scale played by grandmasters. So I always find it incredibly interesting. I remember the comment. Sorry,
the best asset taken over, right?
Yeah.
So that's the other way of thinking about this is ultimately, big companies will take over small companies if they've got something worth acquiring. And then they end up building the mine or at least expanding the mine. That's also the typical thing. So when we think about building a portfolio, you want to have, as we think about it, a barbell approach. You have at one end of that barbell, you have your big liquid cash flowing entities that have a large diversified portfolio of assets that reduces the risk. And then at the other end of the barbell, you have those earlier stage, higher risk, of course, but not, companies who are trying to find or develop, the next big thing. Now, if it's good enough, they'll get taken out. They'll get before it really sees the light of day.
Well, this is actually quite fun. For the small caps, in the small caps, do you take new listings in that portfolio, or is it a different fund?
We can do. Yep.
Okay, so when you're looking at a new mine coming off the market, we've discussed a lot about gas. Let's say we haven't gotten the copper, Dr. Copper and our friend Gold. So when you're looking for a new project coming on, I think there's a couple of IPOs. Well, there was 3 IPOs recently. One was Copper Gold. I think Far Northern's Resources is about to IPO up Queensland way. So there's a couple of projects coming on. What do you look for when you're looking for a new listing in a Copper Gold play?
Really depends. So, for example, most recently you've had Metals Acquisition Corp, right? So, now that's a somewhat unusual IPO in that they have an existing mine, the CSA mine, which is out in Cobalt, and that is actually a very old mine which they acquired from Glencore. So, to come to market with what's actually a very mature asset is quite unusual. Having said that, you've also had 29 Metals come to market. Now, that was actually a sell down by EMR, private equity, of also a portfolio of relatively mature assets. The alternative is exploration or development plays. Companies who've got tenements, they're drilling or looking to drill out, and they're raising the money in the IPO to go and pursue that exploration. But they're quite different risk profiles. So, whereas Metals Acquisition Corp, per its name, has a strategy to, as they've bought a mature mine, they will more than likely buy other producing assets to build out a portfolio of producing assets, and gradually reduce single mine risk within that portfolio. It's got a management team who've got a track record of buying troubled assets and turning them around. So that is their MO. But yeah, so as I say, otherwise you've got a management team that might have a more of an exploration bent, and they're looking to develop or build out an undiscovered portfolio. So it's very different. But what you're looking for is the skill set within the management team. You're looking for a clear line of sight, a catalyst pathway for news flow, and you're looking for obviously appropriate funding for the business model. In the case of an exploration play, you want them to have sufficient rope to go out and drill a number of wells, not just one, because it's the classic case of, as you touched on earlier, fundraising A, B, C, D, and E. You don't want to be that sort of living hand-to-mouth scenario where good news actually gets sold because the market knows that you're just going to be passing around the tin yet again to fund the next well. So you want that relative degree of funding comfort to enable a company to pursue its strategy.
So from my understanding, simply for the listeners, the two main things you're looking at is essentially to pick up a cash flow asset spun out from a legacy business that they can potentially work better, and then utilize that asset, which might be a bit more expensive. The margins aren't there, but at least it's got cash flow, and then looking at a number of bolt-on acquisitions for businesses to beef everything up. They have a good team. They can essentially streamline it. And then secondly, I suppose startup is a good way of thinking it. And then startups are incredibly exciting, finding a unicorn. But the problem with startups is cash flow and runway. So
Correct.
whether or not they can get where they need to be with the cash and the runway, which they have.
That's right.
Right. Excellent. Okay. So one comment I remember you saying at Seed Partners, is this true? And I've been thinking about it. When from bottom of a crash of a cycle to commodities, is it generally true that normally goes up 10x? I remember you saying that. Like if you're looking at lithium, is that bottom to top after a crash on the run up?
Look, it can be all of that and more, right? And it really depends on. So equities will trade much greater multiples than the commodity itself. But if you look at lithium as an example, bottom to top in they're thousands of percent, literally, the moves. And I mean, look at Azure, that was one of the more spectacular things I've ever seen, to go literally 12 months ago, talking about, an exploration play for lithium, and trading, 20 cents to being taken out at something approximating $4 within about 6 or 8 months. I mean, it was spectacular. Now, there are a number of factors going on there. Number one, you obviously had significant success with the drill bit. You had some very deep-pocketed strategic investors, shall we say, who were playing a long-term game. And the asset was located in a jurisdiction which is very mining friendly. So, ticked a lot of boxes. What you've obviously seen, interestingly as well, is that it all occurred in an environment where the lithium price was going through a significant correction. So that's what made it even more extraordinary. Now, what this sort of goes to my point earlier about the cycle that commodity companies go through. What you've actually seen with the lithium market is because it's very nascent in and of itself, it was on its knees, and it's actually not that long ago. It's mid-2020, and the spodumene price, lithium spodumene concentrate, 6% concentrate, was trading sub $400 a tonne. Now, it's come back to something approximating $1,000 a tonne now, and everyone's wringing their hands going, oh my God, what's going on? No one's making any money. Well, need I remind you, it was 40% of today's price only a couple of years ago. Now, in between times, it spiked significantly to thousands and thousands and thousands of dollars a ton. So, yes, to your point and your question, commodities can go many, many, many X, particularly these more nascent commodities, but the equities will do that on steroids.
Yeah, no, I'm just looking at the lithium carbonate price on December 21st, 2020. It was like 26,381. It peaked November 7th, 2022, roughly at 610,000. It's 20x. Now it's down to 98,500. I suppose, and look, a lot of people listening, just like, we've seen with many other investments, after, buy now, pay later, everything rips up, consolidates and goes again. Same as commodities, probably substantially more. So what part of the cycle is lithium and how far away do you think, how long do you reckon it'll take before lithium starts to climb back up again?
Yeah, look, it's at a very interesting juncture right now. To say you've seen it pull back significantly to the extent that we are definitely into the cost curve. There are lithium miners out there today who are not making it; they're losing money. Now, obviously, the reason we got to this point is because there was a supply response, particularly out of China, and all that low-grade material that was coming out of China was brought on very quickly, and at a time when the demand for lithium is still really at its relatively early stages. Obviously, I'm sure your listeners well know what lithium is used for. It's used in batteries, and we are still at the relatively early stages of the build-out of batteries, specifically going into electric vehicles primarily. But what we've got today is, with the pullback, there is some supply rationing starting to occur. We are seeing some interesting responses out of, particularly those more marginal tons in China, what's called the lepidolite supply in China, which is very low-grade supply, and actually has a very significant environmental footprint, which is conveniently forgotten by many in the EV camp. But what you've got is that supply response starting to occur. The concerns have been that demand has moderated or will moderate, particularly in China, being the biggest producer of electric vehicles. That's actually seeming like it might hang in there, actually, for 2024. So we've seen the prices come back. The equities have pulled back significantly, and it's looking increasingly interesting from an investment perspective to really start getting involved, particularly when you've seen companies like Pilbara with extraordinary short interest. It's certainly ripe for a squeeze.
Yeah, PLS and Mineral Resources are quite interesting. Been watching them closely on their trading behaviour. The Mineral Resources has been swinging substantially from low 50s up to 71, and I think technically it's on a climb again. But
that's right.
They also have iron ore assets. Actually, that's what we haven't touched on. Iron ore, which is in PLS and Mineral Resources, iron ore. What's your thoughts on what's happening with iron ore?
So this comes back to, and this is an interesting one, right? So iron ore was actually one of the few winners of 2023. Obviously, in that presentation the other day, the biggest win for us by an absolute country mile was our uranium exposure. But within the Australian market context, if you were an iron ore producer, you were one of the few places which actually made money through 2023, because frankly speaking, the price remained far stronger than many expected. Now, why is that? The expectations were for weakness because, and again, coming back to points I made in that presentation, there's a perception out there that the Chinese economy is heading to hell in a handbasket. And now, part of that is because of the challenges of the property market in China. And there is no easy way for that property market to solve its challenges. It is structurally significantly challenged, and it will take a long time to fix. But where the market, I think, got itself into a bit of a negative spiral was the expectation that the Chinese property market was the only driver of steel demand, and therefore, with that negativity, all pervasive, it led to perception, or at least expectation, that the demand for iron ore would be weak as well. What actually transpired was that Chinese steel production actually ended up being still over 1 billion tonnes a year. The reality is that there's, the iron ore supply market is still obviously controlled by a very small number of players, and the cost curve is very flat. So obviously you've got BHP, Rio Tinto, Fortescue, and Vale as the listed players, who are a very, very significant component of that market. With that, steel production remaining fairly robust, and the fact that there wasn't significant supply coming into the market, actually the price remained relatively high. Now, the other aspect which drove some ongoing build-out of or requirement for or demand for steel in China was their infrastructure build, and that ongoing requirement for steel in that build-out. So it's not just property related. And the reality is, look, do I think Chinese steel is a high growth market? No, I don't. But what's been more interesting actually in recent times, and it's sort of, I think, caught many market participants by surprise, is actually the rise of India. And India's demand for iron ore to build out their or feed their steel mills is significant.
Can we dig into that a bit? Because my knowledge on what's happening in India with the growth, I hear snippets, but I really haven't gone down a rabbit hole on it. What is happening with the growth in India? And as you said, the demand for resources. And do you think that's what's driving, as you were saying before?
I do think it is a reasonably large driver, certainly from the marginal perspective, that sort of the new additional demand tons. Estimates are that India, producing somewhere over 100 million tonnes of steel today, could grow to 500 million tonnes within the next couple of decades. Now, a couple of decades is a long term, but the reality is this growth, the hope, shall we say, that sort of sat around India seems to be perhaps finally manifesting itself. Obviously the population base of India is very significant. Very similar in scale to China, and where people sort of looked at that previously and thought, well, that's the next driver of growth. The reality has been that the constraint, ironically, on Indian growth is the fact that it's a democracy, and you don't have the ability. It's not a command economy as China is. But what's happening now with India, very interestingly, is this, arguably law of big numbers. So if you think about, Chinese growth rates, when you're growing at 5% from 1 billion tons of steel, it's 50 million tons. When you're growing at 5% from 100 million tons, it's only 5 million tons. So just to give you some feel, that law of big numbers, that's why it becomes exponential. So India, has some iron ore of its own, and historically has sourced the lion's share of its iron ore domestically. But as their industry is growing, you get that marginal ton has to be imported, and so suddenly you've got a new player in the seaborne market who wasn't really there before, and they're looking for high quality iron ore, and interestingly, they're also looking for met coal. So
I was just about to ask, what's the other commodity they're looking at? Because you just go one.
Met coal is a big one. So you need the best quality metallurgical coal for steel making, and they will be very strong participants in the seaborne market for that as well.
Yeah, that demand doesn't sound like it's going away. It just sounds like it's building quite a lot.
It is, and it will continue to. I mean, obviously, there's around steel, there's the work being done around so-called green steel. whether that's using hydrogen, or I think what's more likely is, well, you get the build out of EAF's electric arc furnace production as opposed to blast furnace, but utilizing pellet, very high grade pellet, so what they call direct injection pellets. So that's what will probably occur in the US, and in the newer mills being installed in other places around the world, they'll go to EAFs, and so your carbon footprint of these high-grade iron ore pellets is far lower than traditional blast furnaces.
Yeah, that's fascinating. So with the energy the population is getting bigger across the world, so everyone requires more energy. Obviously a number of countries want to go ESG, but what I find always fascinating about policies which come out is, you've heard of the rubber band expression, right? When something gets so pushed down because emotionally, people are standing on a soapbox, shaking their finger, going, "You shouldn't do this for moral and ethical purposes," but then smart money just proceeds to wait and be patient, and they love it because things get pushed down substantially below when they should be, and then it snaps back so aggressively.
Yep. Yeah.
Which must be incredibly fun to invest in.
It is. And for us, really the best recent example of that is uranium.
And that's where I wanted to go to. That's kind of what I was going to. I really want to look. Why don't you just give exactly what you said, the seed partnerships, an explanation of what's happening in the world of uranium, because that was fascinating to hear your thoughts on the landscape of uranium.
Yeah. So look, uranium has faced no shortage of headwinds, right? Certainly post Fukushima, most recently, which, as it happens, is 13 years ago now. 2011, when Fukushima occurred, and that really damaged, obviously, the appetite for nuclear power globally. But what you've got today is this growing recognition that in order to decarbonise our power generation network, we can obviously pursue renewable power, but the reality is that we do need a very significant base load support for that, the intermittency of renewable power that nuclear power can fulfill. And this sort of growing recognition around the world is really sort of finally come to light. Whether that is in the US, where the Biden administration obviously came to power on a very significant decarbonisation related platform, with the intent of actually decommissioning all their nukes. They very quickly realised that they were never going to achieve anything like their decarbonisation goals if they were to do so. So they have completely suspended all those plans. And indeed, we've seen in the last 12 months the first new nuclear power facility open up in the US in decades. In Europe, you've seen nuclear power added to their sustainable finance taxonomy after much debate and hand-wringing, of course, led by the French, who are obviously very big supporters of nuclear power. In China, they are building more nukes than they ever have, and indeed globally, we are now building more nuclear facilities than we have since the 1970s. What this means is that in a market today that is roughly 180 million pounds of demand, we are supplying that demand with about 130 million pounds. So we're 50 million pounds short. Now, where that has been filled historically was from decommissioned nuclear warheads for a long period of time, and of course stockpiles that built up post Fukushima, so more recently. But what you've got today is this, as I say, this realization that nuclear power has or needs to be a component of our power generation fleet from a carbon perspective. But the reality, and this comes back to the point around permitting new mines, there's still significant NIMBYism going on, whether it's regards to where these nuclear facilities are located or indeed where the mines are located. And we just don't have the ability to build supply quickly to meet that demand, which is why you've got a situation where the commodity price, and we've been banging on about where we thought the upside occurred here in uranium. And well, to be fair, we were too early. We were talking about this and watching the uranium price go the other way on us. But what we've seen more recently is the uranium price run. It was trading not that long ago, sort of $30 a pound, going back a couple of years. Just recently, it tipped into three figures, over $100 a pound. And the reality is, we still have a paucity of new supply coming. So we think there is still significant upside to come here. As I touched on earlier, it's been a tremendous investment space for us, through 2023, as a lot of the market came to the realization that maybe there was a thematic here to invest in, and we were already set. And as I say, I've been talking till I'm blue in the face about some of the favoured names in our portfolio, and thankfully that's played out. But when you're seeing
what are the names in the portfolio in uranium?
Yeah, so we have a bit of a spread. I mean, within the global resources portfolio, our biggest position has been Boss for a few years now, listed here in Australia, done very, very well. Actually had a nice little pullback since the start of the year, touched $6 a share, came back to about $4.50. We've been buying some more just in the last week. We think it's like any surge in markets, there will be periods of consolidation, and that's what this is right now, and just provides another opportunity. But Boss, in Canada, the biggest producer, Cameco, is a good go-to. It's the biggest listed producer in the developed world, and it has a very diversified portfolio now, because they're not only in uranium mining, they're also in enrichment now, having acquired Westinghouse. So they're working their way down the value chain. But that is a great go-to name for I guess a long-only investor who wants to be able to sleep at night without significant risk in their portfolio. Outside of that, Paladin, also here in Australia, also approaching production, restart of their facility, not dissimilar to Boss, who's just about to start up. And then in the US, we have a company called Energy Fuels. Now, Energy Fuels is listed both in the US and Canada, and they have the only operational, fully permitted and operational uranium mill in the lower 48. So it's a highly strategic asset. They can actually process not just uranium, but also rare earths. So it's a bit of a double threat, and generating lots of cash flow whilst they build out their upstream mines as well.
What are your thoughts on Deep Yellow? Because is it a situation how there's just so many companies around, you can't have all of them, or are you specifically like, say, I see always hear we've invested in the past Deep Yellow. I was just curious in your thoughts on that company.
Yeah. Look, run by a bit of an icon, frankly, in the uranium space, John Borshoff. He built Paladin, into a highly successful uranium miner back in the last cycle. Deep Yellow are making real progress. Mulga Rock making progress. We do actually own Deep Yellow in our nuclear energy opportunities fund, so that the uranium focused fund. And look at on valuation sense, it actually looks pretty good. It's not as richly priced as a Paladin or a Boss, but by the same token, not as well progressed. It's not as mature, but it's not too far behind.
If we lean into the expression "nothing goes up in a straight line," and also the point you're making before that, from bottom to top, there's potentially 10x or more, or just a bit less. I'm just looking at the uranium price, US dollar pounds, which on the 9th of March 2020 was $24.37. So let's say flat line for a number of years there, around 24. So it hit 104, and today's trading at 95.
Yep.
So I suppose, what's that? Nearly 4x has gone up. But the way I suppose maybe to look at it is, I know you touched on before, the demand and supply of uranium. What is currently the demand? What is the supply? What's the difference? And how long do you reckon that's going to be around for? Which I would assume would probably drive this price.
Yeah, so it's
potentially for years to come.
talked to, so my colleague Guy Keller, who runs our uranium fund, the Nuclear Energy Opportunities Fund, he makes a very valid point that yes, we've had a run to 100, but we are dealing with a market that has a deficit yesterday, today, and tomorrow. And that deficit today is around £50 million on a £180 million market. I touched on the fact that we've been feeding that deficit with stockpiles for a number of years now, but those stockpiles have been whittled away. Those stockpiles built up in Japan on the back of Fukushima are largely whittled away. And part of that is because they're accelerating their restart program as well. So, Japan has 50 odd, nukes, and they suspended most of them on the back of Fukushima. But, interestingly, you've got a situation where, there was significant pushback from their population. And when the most recent president was elected, he came to power on one of his platforms being restart of the nuclear facilities. So we've chewed through that stockpile, and it's exactly the reason why we've seen prices, really start to jump, because we just don't have the fat in the system anymore. And uranium's not the only one with a very low stockpile. We talk about stockpiles being very low for a number of different commodities. But yeah, so that's the scale of the deficit today. Look, there's the supply response that is brewing, whether it's Boss or Paladin. But on the flip side to that coin, you've got the other very large producer of uranium being the Kazakhs. The Kazakhs updated their production guidance for 2024, and they cut 10 million pounds from their guidance. So, it's not doing too many favours to the supply response. So you need every extra pound that Boss can deliver or Paladin can deliver. And meanwhile, the demand scenario continues to strengthen. As I say, coming back to my point about, the renaissance of nuclear power, and governments around the world starting to recognise the upside here. And what's important is it's not just an upside today or tomorrow or next year. This is going to take years and years and years to build out that supply. So there's this sort of growing inventory of new demand that's coming down the pipeline that will require constant feeding for many years to come.
Well, one of the biggest things, wouldn't you agree, is this whole ESG thing. You can't just say, no, you can't. You have to stop using fossil fuels. It's like, okay, cool. What do we use? Where's the energy going to come from? So I suppose to that point is, I suppose the thing that drives myself nuts and a lot of other investors nuts is you read about information, as you said, you're too early. I completely understand that. You read information coming, through the news cycles, and it's saying, you see the pattern, you line yourself up, you do your research, you make a bet, and you're like, yep, this is going to play out 6 to 12 months. Well, fast forward how many years later? So, but maybe one way to potentially put that concept, in front of our eyes, or make it more understandable, is how many nuclear power plants do you think globally are in the process of being built? And then secondly, how long does it take to actually build one? Because then, you know what I mean? Like, because they come and go, hey, we're building 50. It's like, okay, that's great. But, when will that be used? Because that happens after it's completed.
It does depend on the size of the facility, right, as to how much that they consume and how long they take to build. So, rough rule of thumb, most of these are give or take about a gigawatt. That's a rough estimate of how big these are. And they consume about 500,000 pounds. So, if we're building 50 to 60 today, that's another 25 to 30 million pounds of demand on an 180 million pound market. So there's your rough numbers of additional consumption that's coming into the market. Now, they do take years to build, but so too does any major power infrastructure. Snowy 2.0, I'm looking in your direction. But but the other interesting piece here, and this is also, I guess, a bit of a new development in the nuclear space, is the small modular reactors, which you may have heard a little bit about.
No, I haven't. What are they?
So small modular reactors are, as they say, smaller in scale than a traditional nuclear facility. So as I say, if a typical nuclear power plant is around about a gigawatt, these small modular reactors might be 200 to 300 megawatts. So much smaller in scale.
How much land does that smaller one take up? Like, I'm just trying to work out the size. Like,
yeah. So if you think about, as I say, and they're modular, so the idea being you can stack them up next to each other. But a small modular reactor of that scale, sort of 200 to 300 megawatts, is probably going to be about the size of, have a footprint of, say, half a football field.
Oh, they're not that big.
Oh, no.
That's tiny.
That's it.
Half a football field.
Yeah.
Including the stands, or literally just the touch that.
That's right. Yeah, it's actually futsal with stands. So much smaller. And the theory being
glad I asked that question, because in my mind I'm literally thinking like it's the size of like Allianz Arena, or something massive like the old Telstra Stadium.
Yeah, so they're much smaller. I mean, obviously you have the support infrastructure around them, but they are much smaller in size. So
they can potentially become like the electrical power grids kind of running around the city. You can actually just slot them in. Well,
that's so they become. You can obviously position them closer to your users, or you can have them set up for very specific purposes. Now, if you think about the longer term future here of what this might mean, there's, for example, in China, the contemplation of having SMRs that just feed individual towns or communities, and one of the other resources that is going to be more and more strategic and short in supply is water. So if you have an SMR, you can use your SMR to power your desalination plant, provide municipal heat for your local communities, and obviously provide your clean, carbon-free power to power up your lights and the like, whilst also feeding your electric vehicles that you're going to be driving around your local community. So that this is obviously somewhat distant at the moment, but the reality is that any power infrastructure is expensive. The argument we have in Australia that nukes are too expensive is frankly built on old science. And you can't tell me for a moment that, as I say, Snowy 2.0 is going to be a cheap endeavour. I mean, started out as a $2 billion endeavour and now it's 12 and it'll be more.
How does that make any sense that you make electricity because obviously dams work, but then some genius figured out, hey, let's pump it back up again, then run it through a second time? That makes no sense. Like, clearly the energy cost at the time must have been incredibly cheap. Do they factor into the, commodity prices move? It just makes no sense.
Yeah, pumped hydro is conceptually interesting, where you're utilising obviously your power generation from solar or whatever during the day when it's not being consumed as much to pump your water back to the top of your reservoir, and then when you don't have solar power and people want to sit at home and turn their lights on, you then generate power from, allowing the water to run downhill through your turbines. Conceptually, it makes some sense. Where this, $2 billion was never the right number, is the first comment I'd make. But also, they plowed into it without the appropriate studies being completed to understand the geological challenges they were going to encounter subsurface. So part of the issues they faced is that, they're putting these massive tunnel boring machines into the ground and hitting all sorts of subterranean ground, which has been very, very difficult to navigate. So it slowed them down or cost them more. or both. So, I'm not here to tell you that nuclear power is extraordinarily cheap, but don't for a moment tell me that it's outlandishly more expensive than the alternatives.
No, look, I really appreciate your thoughts on that because, again, and this is one thing I've listened to a number of podcasts discussing uranium. Is you mention uranium, people immediately think of a mushroom cloud or Chernobyl or what happens in Japan, but they're fault lines, they're old technology. I don't know if you've seen the videos of people with Chernobyl and they're looking at the layouts. Those things look like, I don't know, the movie Apollo 13.
Yeah.
With Tom Cruise, the tech,
Mhm.
the buttons are the size of your thumb,
Well,
two
it's
thumbs.
dead right. Actually, a little tidbit for you on Fukushima. The modern perception out in the public is that the ground shook, the wave came through, and the nuclear reactor blew up. Well, what actually occurred was that this was a 40-year-old reactor that was built to withstand the mother of all earthquakes, and it did, as it happens. What was the issue is that the operators, TEPCO, had positioned the backup power units, the diesel generators, in the basement. Now they were
Oh,
advised to put these generators on the roof, but they didn't. So when the wave came through, the mains power operating the cooling systems failed. And that's when the diesel generators should kick in. But they were flooded.
yeah.
And that's what led to the failure. It was the diesel gensets that failed, that failed the cooling system. Now, if those diesel gensets were on the roof as they were designed to be, we would not be having this conversation. Now, do you know how many people were killed as a consequence of the meltdown at Fukushima?
No. How many?
Zero. People who died in Fukushima died as a consequence of the earthquake and the tsunami, not what happened at Daiichi 1.
Well, that makes a lot of sense. But the other thing people discuss is nuclear fallout. So the deaths and the consequences, down the track. So I don't know if that's been measured. And that's what terrifies people. And the other little fun fact that people don't realize, in Australia, South Australia, that's where they're essentially tested the nuclear bomb.
Correct.
And people do not know that.
Exactly. They all stand there with their sunglasses on.
Yeah. And they go, oh, this is a nice drive. It's like, hold on a second, why are my kidneys not working anymore?
Yeah, there's far worse radiation, background radiation out there in that part of South
Australia, right?
Than there is in Fukushima. But also, a long-haul pilot has much greater build-up of radiation in their system than anyone living in the Fukushima district.
Absolutely crazy. Look, I'm just conscious of time. One last question is, what are your thoughts on where copper's going? Because, again, another supply problem, but it doesn't have to be as extensive. But what's your thoughts on Dr. Copper?
We're hugely bullish on copper. The reality is with copper, obviously copper being used extensively in wiring. As the world electrifies, we are going to need so much more copper. It's not funny. Now, whether that's to do with wind turbines or solar panels or electric vehicles, the reality is we consume so much more power just in our day-to-day, let alone shifting to electric vehicles. What do you think is driving the usage of Wi-Fi, internet, data centers, the AI surge? I mean, just the build out of the use of AI on a Google search platform will lead to a multi-factor increase in power consumption of Google. Multi-factor. I'm not talking about small percent. I'm talking multi-factor. Now, we need to generate a huge amount more power in order to drive that. How do you do that? You need to consume an awful lot more copper. So conservative estimates are that copper consumption, copper demand will rise to about 30 million tonnes a year by the end of this decade from about 23 million tonnes today. So let's assume that's 1 million tonnes additional demand per year between now and 2030. The world's biggest copper mine is Escondida, run by BHP and Rio Tinto. It produces around about 1 million tonnes of copper a year. and declining, by the way, because grades are declining. Now, the replacement cost of Escondida is around about $25 billion, maybe more, maybe $30 billion today. So we need to be spending $25 to $30 billion every single year between now and 2030 on new copper supply alone. Now, early on in the podcast, we talked about management's reticence to invest in new supply. Name me a mining company who's investing $25 to $30 billion a year at the moment on new copper supply. It's not coming. It's not happening. So the point being, there have been the bears out there on copper are saying, yeah, but we've got a few big new mines that are coming or are in ramp up, whether that's Kamoa-Kakula in the Congo, or it's mines in Chile or Peru. We're adding about 1 million tonnes between last year and the end of this year. Well, that's great, except there's nothing else in the hopper. So what else is going to be delivering on that 30 million tonnes in a few years' time? We've got no stockpiles left. So the reality is the copper price has to go higher to ration demand. Because you can't have negative stockpiles. That's just not physically possible. So what has to happen is the price needs to rise to ration that demand factor. So how do you get exposure to that? Well, you need to invest in copper producers, not just hopefuls, but producers. And for us, you invest in the big diversified players like Glencore and Teck, or you invest in pure plays, the big pure plays like Freeport, or in Australia you've got Sandfire, or even Metals Acquisition. But you need copper exposure in your portfolio because there is a massive structural squeeze coming.
Someone just needs to figure out the infighting when it comes to Bougainville and get that copper gold mine up and running, and I think it'll solve a lot of the world's problems.
Yeah, well, name me a management team who wants to go to Bougainville.
I can name a couple. I've been chatting to them, but it's you can get the people on board, but then there's just too many interests, and it becomes very, very, very challenging. Look, I normally finish on what keeps you up at night, what gets you out of bed in the morning. But you mentioned Congo, and it kind of. I was listening to Joe Rogan, and he interviewed a guy who actually physically went there. And I suppose it resonated. I just want to hear your thoughts on Congo and Cobalt specifically. We walk around town, everyone lives well. You look at all the electronic devices. I can't think of one electronic phone that doesn't have Cobalt in it. And I think about all these people, shaking their finger going, you can't do this, you can't do that. Meanwhile, plastic straws, plastic bags, don't get me started. But, I hope I don't finish. I don't mind. Actually, I don't care. I'm just kind of over it. Meanwhile, they're on their phones tweeting about it and just being a pain in the ass, excuse my French. But do they understand that cobalt is artisanally mined in the Congo? And if you read Google or whomever it is, they never specifically state. It's kind of like hidden behind a number of layers of where it specifically comes from. So I suppose my two question is, what percentage is actually coming out of the Congo? I think there's a number of cobalt mines in Australia. And are you exposed to cobalt? Is there a solution to the cobalt problem? I'm just curious what's happening there, because people discuss ESG at lengths in their portfolios, but people don't realize that one of the biggest things that they invest in, everything's got cobalt in it. And there's women with their babies on their back getting cancers, pulling this stuff out of the ground with their hands. And it's not discussed.
You've hit upon a key issue here, and it's an endless frustration, and why supply remains a challenge for many commodities. And that's that ignorance of where these commodities are coming from. To your point, there's many agitators that just will happily tell you that all mining is bad. And as you say, spread the word about the latest protest on their mobile phone. Forgetting that, of course, mobile phones unfortunately don't grow on trees. Look, it's a key issue, and it's a challenge that will sadly continue to be faced. With regards to cobalt specifically, the reality is that the DRC is a bit of a geological anomaly where there are primary cobalt mines. There's cobalt typically is a byproduct, so it comes as a byproduct often of copper mining. And so, for example, in Australia, it's a background commodity to, in some cases, other copper mines. So we do produce some in Australia. But you're right in that, some of the cobalt that comes out of the DRC is, shall we say, not exactly ethically mined. Now, that's not to say that all of it is like that. The Glencore, for example, does mine cobalt in the DRC, and this actually goes to a bigger point, and something that some mining companies are looking at ways of developing is essentially having a bit like a blockchain attached to, the tons or pounds of the commodity that you produce, that enables the end consumer to be able to trace, those pounds back to some sort of, responsibly produced source. It's still a work in progress, is the bottom line. But this is where pressure needs to be applied upon the OEMs. Whether it is the Apples or the Samsungs or the Fords and the Teslas and whoever else who are consuming or utilizing such commodities. The onus is on them to also source their product from a responsible source, and that will do a better job of driving out, the unethical suppliers.
It probably should, in all honesty. Like, I quite like what you're doing at the Kimberley Syndicate with the diamonds, but again, what's his name? Titanic, our friend that did Blood Diamond. What's his name again?
Leonardo DiCaprio.
Leonardo DiCaprio, right? He shone a light on blood diamonds, and everyone hates blood diamonds. That's like one diamond. Everyone's got such an uproar, and I think the reason why people have such an uproar when it comes to diamonds is because every wife is wearing that on their finger, and every husband wants to, get engaged and give her one. So it's a constant reminder that they're looking at this rock on their finger. What I'm just find fascinating is everyone's got a problem with that, but meanwhile they're tweeting about that they're taking the photograph with their phone of. It just makes no sense. Yeah. Anyway, but maybe we'll get there in time. Look, Todd, I really appreciate your time. This conversation is fascinating. Could be here for another hour and a half. But look, if anyone wants to learn more about Tribeca Partners, Investment Partners, and what you do in the funds, where should they go and how can they find you?
Yeah, you can find us online. Obviously, the Tribeca Investment Partners is, if you Google search Tribeca Investment Partners, you will find us. TribecaIP.com is our website, and you'll find all the material on all of our product offerings. We are, we believe, a pretty entrepreneurial outfit. We do offer very niche products that we think are difficult for others to replicate. We've been doing this for a long time. We've been around a long time, and we are all believers in the product. I'm a big investor in my own fund. And all the portfolio managers are. We think that's really important that we've got alignment with our investors and feel the good times and the bad.
Well, it's been great having you on, and I really appreciate your insights. And I hope everyone has enjoyed that because it's quite eye-opening. The wide world of resources.
It's been a pleasure to be on here, Murdoch. I apologise. I can talk under wet cement with a mouthful of marbles when I get started. So, but it is a topic I'm pretty passionate about. Hopefully that comes across. That's what you get with Tribeca. You get passionate people.
I love it. All right, Todd, have a great day.
Thanks, Murdoch.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.